The world of elite quantitative trading, it's really a world of secrets, isn't it? It's got its own language, a secret code that moves billions of dollars every single day. Well, today, we're going to crack that code. We are going to deconstruct a real-world professional market briefing, step by step, to show you the hidden mechanics of the market.
All right, listen up. This is the kind of warning that goes out on a prop desk floor. It sounds intense, right? Maybe a little intimidating. But here's my promise to you. By the end of this short explainer, you will understand exactly what this means, why it is so critical, and how it sets up a multi-million-dollar trade. So here's our roadmap for today. First, we're going to drop in on the morning briefing to set the scene. Then we'll hunt down the market's true price, the real center of gravity for the day. After that, we'll uncover the hidden engine of volatility, see the invisible walls that institutions build, and then break down their core strategy. And finally, we'll look at the most important piece of the puzzle, the escape hatch for when it all goes wrong.
Okay, let's get into it. We are dropping into a very specific moment in time, the morning of Wednesday, February 25th, 2026. Now, on a day like this, the pros, they're not just looking at the price you see on the news. No, they're operating from a completely different set of coordinates.
And this right here, this is the fundamental disconnect. It's the whole game. While most of the world is staring at the standard SPX index, the real gravity, the center of all the day's action, is happening at a number that isn't even on the public chart. So the question is, how do they find it? They find it by calculating something called the implied spot. I want you to think of this as the mathematically precise center of the market's gravity for this one trading day. It is the point around which everything else will revolve. So what is it, really? Well, the implied spot is the price dealers are using to balance their own books. It's not some big secret. It's just a number most people don't bother to look at. They calculate it by taking the normal cash index and just adding a small premium from the futures market. This gives them their anchor point, their true north for the day. And for our day, that critical number is 69.15. Now, this isn't a guess. It's just math. This price comes from a massive plus 22-point premium on the futures market, and that tells the quants everything they need to know. It tells them that this level, 69.15, is the only place dealers are actually positioning their hedges for the entire day. But look, price is only one part of the equation. The other, and frankly more powerful part, is volatility. A sudden change in volatility acts like a secret engine, a hidden force that can violently shove the entire market around. To understand today, you have to look at yesterday. Yesterday was chaos. The market was in what traders call a regime 4 panic. The VIX, the fear index, it spiked over 22. But overnight, all that fear, it just evaporated. The VIX collapsed down to 1935. And this massive drop in fear is what's going to power our secret engine. That engine is called VANA. Now, it's one of the option Greeks, which are just fancy terms for different forces that mess with option prices. But here's the key idea you need to get. VANA is a force that compels dealers to act when volatility changes. It's not a choice. When fear collapses, like it did today, VANA kicks in and forces their hand. And this is the chain reaction step by step. The VIX craters. Dealers who had sold puts to their customers suddenly find their positions are not hedged correctly anymore. So the VANA effect forces them to mechanically, automatically buy futures to rebalance their books. And this huge wave of forced buying is the tailwind that fueled the market's big recovery. Okay, so we have our central price, 69.15, and we've got a powerful tailwind pushing things up. Now, the big institutions step in to build a structure around this dynamic. They create invisible walls to contain the market for the rest of the day. The first wall they build is the floor. Quants can see it right on the tape. Institutions are aggressively selling puts at the 68.70 strike price. This creates a synthetic support level, a soft floor that makes it really difficult for the market to fall any further. And at the exact same time, they build the second wall, the ceiling. They are shorting a massive wall of calls at the 69.50 strike. And this creates a hard cap on any rally, effectively boxing the market in. And what they're building is what we call a synthetic iron condor. You can see it right here. They've established a super clear range. You've got the 68.70 floor below and the 69.50 ceiling above, and they act just like guardrails, designed to keep the price contained for the entire trading day. So what's the goal here? What's the trade? Well, it's not about betting on whether the market goes up or down. The goal is simply to profit from the price staying within this predefined range. And they do this by harvesting the options premium. The trade logic is, well, it's beautifully simple. They sell those expensive calls up at the ceiling, they sell expensive puts down near the floor, and then they just wait. They let time pass because time decay will absolutely crush the value of those options. Their profit comes from the market just staying put. The force that makes this all work is another Greek called charm. You can think of charm as the gravity of time. As the end of the day gets closer, charm's effect gets stronger and stronger, and it pulls the market's price like a magnet right towards that key 69.15 implied spot. This is what they call the pin. Now, this all sounds like a perfectly oiled machine, doesn't it? But this next part is the most critical part of any professional strategy. It's knowing exactly when that machine is broken. This is all about rigorous, totally unemotional risk management. For this entire strategy, there is one number that matters more than any other, a VIX reading of 20.50. This is the hard stop. This is the break glass in case of emergency level, the line in the sand. And here's why it's so crucial. If the VIX spikes back above 20.50, the entire mechanical thesis just falls apart. Those Vanatel ones we talked about, they reverse into powerful headwinds. The machine is broken, and the desk's mandate is crystal clear. You exit the trade immediately. No questions asked. Flatten everything. And that brings us to the professional sign-off for the day. This one sentence, it summarizes the entire ethos. Understand the statistical boundaries, execute the strategy to profit from time, and above all, stay disciplined. So what have we really seen today? The pros aren't trying to guess the future. They're not predictors, they're engineers. They identify the forces at play, they build a machine to take advantage of them, and most importantly, they define the exact point at which that machine fails. It's a completely different way of seeing the world, not as a casino, but as a system of forces to be understood and engineered. Does that change how you see the market?